Walter's um, animals.
I got it. Okay.
We're live, guys.
Good morning, everybody, and welcome to another edition of MSATP TV. Joining us this morning is Jerry Lotz with CostSeg, and Jerry's going to talk to us a little bit about himself first, and then get into details about what cost segregation is. So, Jerry, it's up to you.
Thank you, Bill, and good morning, MSATP members and friends. It's always a pleasure to be here. This is our, fourth or fifth year as a corporate sponsor, and really have enjoyed it, met some nice people that have turned into friends, and I'm thankful for the opportunity to work with you to help your clients save money. So, like a lot of you, I work for myself. I am Maryland born and bred. Did a lot of traveling through my career in medical sales, but now working for myself, I thoroughly enjoy it and enjoy it's an education process. It's a matter of presenting the facts and certainly dispelling some misconceptions that are out there about what I do. But it's fun. It's fun, and it's really a pleasure to be able to deliver on some tax savings results for clients. So the basis of what I do is really that cost segregation piece, where you take a piece of property, building, whether it's newly bought, newly built, even if it's been owned for a number of years, and we do a forensic engineering based study on that property to reclassify, to identify the assets or the components that make that property up, and then reclassify them into shorter depreciation categories. So what may be in a 39-year depreciation category for the entire building, we may find 10%, 20%, 30% or more of that property that can be pulled out of that 39-year class life and reclassified into 5, 7, or 15 years for accelerating the depreciation, jump-starting the deductions to offset the income, so significantly in taxes. So it's like I said, it's a fun place to be. There are a number of misconceptions that are out there, though, and this time of year, as we're kind of in a tax planning time, a pre-planning time for coming tax seasons, I'd like to point out a few of those misconceptions, if that's okay, and then talk about what it is to keep your antenna up for as you're meeting with clients, so that you can better help them to save money. And that's what they pay us for, right? I mean, they pay you to make sure that they're, first off, compliant with the laws, that they're getting the maximum savings that they possibly can, and they certainly are intending that you're going to operate in the most legal, ethical, compliant way as possible. And as tax professionals, accountants, CPAs, enrolled agents, that's a duty that we all have, to operate in the most efficient way and the most prudent way for our clients. So
Why don't you tell us a little bit about what goes into a cost segregation study?
So first off, there's an estimate, Bill. And like I said, whether a property is newly bought, newly built, even if it's been owned a number of years, there's an opportunity to do that estimate and to actually pursue that study without going back to refile past tax returns. If it's a property somebody's had for 5, 6, 7, 10 years, there's no need to refile tax returns. It's just a matter of completing a 3115 form, and we end up taking that responsibility, and then filing a 481A adjustment with the current timely filed tax return. So once we complete that estimate, the client looks at it, and the tax professional, and said, yeah, this is worth doing. It looks like we're going to get a 4-to-1 return on our money, or a 20-to-1 or a 70-to-1 return on the cost of doing that study. Then they engage us to do the work. Then we start gathering all the information, all the pertinent building documents, Maybe there were appraisals done, construction documents, architectural drawings, blueprints, whatever may have been accumulated in that property's file history. Some clients come to us with massive amounts of information in the file histories specific to that building. Some clients come to us with very little information about the particulars that are in that building. Once our home office gets that building documentation and somebody physically goes to the property to do a site visit, to take hundreds of pictures of that property, once home office has that complete package, then it moves on to what's called the engineering stage. If a property is anywhere within driving distance, I love to do those site visits myself, because it really is an opportunity to have a conversation with the owner, oftentimes, or certainly the property manager, somebody who is intimately familiar with the inner workings of that building, and knows a little bit about the history of the building, because you just don't know what you might uncover in a conversation that may not necessarily be visible to the eye at that particular instance. So once all that documentation is gathered, home office has it, our team of engineers and analysts start working on that project. So we'll have one team that works on the project, comes up with some findings. It moves to another group for kind of a double check, and then moves on to a final group for quality control and kind of a triple check. That entire process takes anywhere from 5 to 6, 7 weeks. We are working at reducing that timeline, implementing some new technologies and things so that we can get jobs out the door more quickly without sacrificing quality and certainly integrity in the whole process. So once that 5 or 6 weeks is up, we deliver what's called a set of cost reports that really contain the guts, the meat and potatoes of the project, where it breaks down the different components and actually puts a value on what they're worth today, as it relates to the cost of that particular building. For the major building systems that are in there, and there's 9 major building systems: plumbing, electrical, ceiling systems, HVAC, and others. But we actually put a value of what that is today and a value of what it would cost to replace that system. Those replacement cost values for those building systems really become the framework for compliance for future expenditures on that property. And that all stems out of the 2014 tangible property regulations, where before that, there was not really anything concrete in place for tax professionals to be able to decide whether something was going to be expensed or if it was capitalized. But these tangible property regulations, in the numerous examples that they cite, talk about roughly what they call the 1/3 rule, where if a expenditure on a building system is roughly 1/3 of the value or less, then you're relatively safe to expense that expenditure. If you're spending more than 1/3 of that building system replacement cost value in 1 year, then you better look at capitalizing that. So prime example, HVAC systems worth $210,000 in a larger facility. The owner has to spend $50,000 for some upgrades. Well, 50,000 is less than 1/3, so that 50,000 can pretty much be expensed in that year that they spend the money. If they're coming along and spending $100,000 in that HVAC system, that is well over the 1/3 value of the $210,000 that it's worth. So they better look at capitalizing that. So those numbers become a tax planning tool. If you've got some investments to make some upgrades, if you can keep those yearly expenditures on that particular building system less than that 1/3 value, you can just expense that entire amount in the year that you've spent that money. So, but without those numbers, Bill, they're shooting in the dark.
Okay. So when we talk about doing a cost study, um, it's not dependent upon the calendar time other than the due date of the return, including extensions. Is that correct?
Yes, that is correct. So that's a great question. So unlike a lot of investment scenarios where you've got to have, for example, like defined benefit contributions and things and how programs in place by the end of the calendar year in order for it to count for the calendar year, with a cost segregation study, somebody, initiates one and wants to count it for the 2021 tax filing. We've got all the way up until, October 15th, if that's the extension date, in order to have those final numbers. Keeping in mind, October 15th of the 2022. So, to be able to apply those numbers to 2021 tax filing. Keeping in mind, though, that there's, from the time we engage a study and go through the engineering phase and finalize the numbers, that's probably a good, 4 to 6, 7 week process. So if we're going to get numbers to the tax professional by October 1st, we better look at having all that information in-house, say, the first part of August.
Okay.
Yeah.
Very good. Now, the fee for doing a cost study, is that roughly a percentage of the savings that gets determined, or is it some other fee schedule that you all have?
It's a great question. The IRS really frowns on calculating fees based on a percentage of the findings. So the company CSSI that I represent out of Louisiana has been around about 20 years and has completed over 30,000 projects across the country. Our databases are very robust as far as the history and the work that we've done. So when a client gives me a project to prepare an estimate for, we can go back and pretty much match that type of a project up against the history of similar projects that we've done. We know how much work is involved in that type of process, how
Sure.
much time it's going to take. So there is a set fee.
Okay.
It has nothing to do with the estimated savings that we'll find, but there's a set range of fees there.
Sure. Now, about how old would you say a building, gets to the point where it's not worth doing the cost seg?
Well, if somebody has, with commercial property, it's 39 years. If they've owned something 20 years and have not put any improvements in that since they've owned it, they've pretty much, more than half of compensated for, accounting for that depreciation that's in there. They've taken half of it already. So there's not going to be any 5-year for us to find. There's not going to be any 7 or 15 years. So in that scenario, it's probably not worth pursuing a study. But if somebody's bought a property for 20 years and over the time period has put some improvements in that property, sure, we're happy to run estimates.
Okay.
Obviously, the best time to do it is when somebody first buys that property, because they're starting off with a clean slate, having the assets broken down by an engineering-based method, and having those numbers set up as a framework for compliance going forward. But we do all kinds of properties.
Sure. So
Yeah.
also you do residential rental property.
It's interesting, Bill. When cost segregation first came about 25 years or more ago, it was reserved strictly for the mega $1 million properties, the big 4 CPA firms, very, very expensive. And now through experience and technology, we can actually find value in properties $200,000. So we've gotten a lot more residential rental types of properties over the past 3 years, because our capabilities of finding tax savings in these lower properties has increased.
Okay.
Yeah.
Very good. Is there anything else you'd like to tell us about cost segregation?
It, if there's an opportunity as you're visiting with clients, you've learned that maybe they bought a building, made some major improvements to a building, all of a sudden, notice that this client has got, 3 or 4, or 2 or 6 or 12 or 20 residential rental properties that they've had for a few years. Let us run the numbers. I will never turn down an opportunity to run the numbers because you don't know what you got there until you actually run some numbers for the client.
Sure.
We are so thankful again for the relationship with the MSATP and the members, and excited about the work. And tax laws today cannot be any more friendly than they are for people and companies that own and actually improve property. Even leasehold improvements oftentimes will qualify for accelerated depreciation.
Okay.
Yeah.
Well,
So.
Thank you very much for joining us today, Jerry. It's good information, and I know you've enlightened me about a lot of things that I hadn't thought of with a cost segregation. So it's certainly something that we should keep in the back of our mind. And as we move forward, we meet with clients at the end of the year. Keep Jerry in mind for a cost segregation study on one of your clients' properties.
Appreciate it. Thank you very much. Best of holiday wishes and Happy New Year to everybody.
Thank you. Same to you.
Thank you.
You take care. Bye. And
Bye
to
now.
all our members, we wish you a Merry Christmas and a Happy New Year. And we look forward to seeing you right after the first of the year back at the live seminars. So have a good one.